With regard to indication, it's not possible to, say anything. I have said it earlier also that in the current tightening cycle especially with regard to rates, we have refrained from giving any forward guidance because sometimes it can be, and quite likely sometimes, it may become counterproductive. So we are not giving any forward guidance. We have said that we will be extremely watchful of the incoming data as well as the outlook on inflation as well as what is happening in the overall economy. Based on that, we will decide going into the future months.
Answering questions after the latest Reserve Bank of India Monetary Policy Committee meeting, Governor Shaktikanta Das did not rule out further hikes in the repo rate. On February 8th, the MPC raised the repo rate by 25 basis points to 6.50%. This was done to bring inflation back towards the central bank's 4% target. The decision was not unanimous. 4 of the 6 members of the MPC voted in favor of the rate hike. The RBI MPC has slowed the pace of rate hikes for a second straight meeting. To ensure that inflation remains on target, the MPC also retained its stance of withdrawal of accommodation, and the decision on the stance also saw a voting pattern of 4:2. With the latest rate decision, the MPC has raised the repo rate by a total of 250 basis points since May last year. At 6.50%, the repo rate is at its highest since February 2019. Meanwhile, headline CPI inflation declined to a one-year low of 5.72% in December last year, staying within the central bank's 2 to 6% tolerance band. However, core inflation remained above 6%. Core inflation, which strips away the volatile components of food and fuel, has remained above 6% since May 2022. So, Governor Das reiterated that the stickiness of core inflation was a matter of concern, and the RBI would need to see a decisive decline in inflation. Assuming an average price of $95 per barrel for crude oil, the MPC sees CPI inflation at 5.3% in FY24. Governor Das said geopolitical factors, non-oil commodity price pressures, and volatile crude oil prices would be the sources of risk on the inflation front. Governor Das also said that India's economic activity was holding up well, with the previous rate hikes still working their way through the system. So, further calibrated action was warranted to break the persistence of core inflation and to anchor inflation expectations. The governor emphasized that the RBI would continue to maintain a strong vigil on inflation. Against this backdrop, what do experts think are the chances of a pause in the rate hike cycle?
In my view, there would be a rate pause for the next couple of policies, and it could all be driven by data. So in case we do see that the inflation trajectory continues the way the RBI has spoken of, we may not be expecting any change from the RBI. And I think the reason as to why RBI is being cautious is that it's not sure about core inflation and what could be any external factor affecting headline inflation.
Well, I think the RBI stance is appropriate in the sense that in these uncertain times, you want to keep your options open and you become more data driven. Our sense is that we have reached the peak of the cycle, and I think we may see a pause from here on. And also a change in stance going ahead. But it all depends on what kind of data flows in.
Also, where do experts see real rates standing in the near future? And is a shift in stance likely in the coming April policy?
We are talking of a positive 1% real interest rate, which I think is quite acceptable from the point of view of the central bank. Now, in terms of change in stance, I don't think there will be any change of stance even in next policy. The reason is that I don't expect any of the inflation numbers to be significantly different from what the RBI has spoken of when they meet again in April.
Well, I think as far as the real rates are concerned, they've already touched the positive territory. And I think maybe 1.5% to 2% is what they will reach at some point. As far as the stance is concerned, they will now move towards the neutral stance if they don't hike rates in the next policy. Because that neutral stance still leaves you an option of either raising rates or leaving it unchanged or cutting rates.
The MPC pegged nominal GDP growth rate at 11.7% for FY24. Though RBI's panel did not give nominal GDP growth, it pegged real economic growth at 6.4% and retail price inflation at 5.3%. On the other hand, the budget assumed nominal GDP growth at 10.5%. Major figures such as taxes and fiscal deficit are estimated in the budget on the basis of the nominal economic growth projection. So, is the MPC projection of 11.7% likely to hold true? If yes, what will be the impact?
I think the number of 11.7% fits in well, because if you're talking of 6.4% growth in real GDP, 5.3% CPI inflation, if you add the two numbers, you do come to this number of 11.7%. Now, technically, of course, the difference between nominal and real GDP need not necessarily be the CPI inflation number. It's a GDP deflator, which is a derived number. So I really don't see any contradiction as such out here. The RBI has given a more realistic view, whereas the government is taking a more conservative view, which is the way it should be. Now, if this number of 11.7% is achieved, it will definitely work to the benefit of the government in the sense that your tax collections would continue to be as buoyant as what they were in 22-23.
Governor Das also said that higher RBI output, broad-based credit growth, improved capacity utilization, and the government's thrust on capital spending had improved the growth outlook. However, he cautioned that protracted geopolitical tensions and slowing external demand were downside risks. For its part, the MPC projects real GDP growth at 6.4% for FY24.
I think the factors which were driving growth in 22-23, like the pent-up demand phenomenon in both manufacturing as well as services, is something which is not going to get replicated in 23-24. So I assume that they are looking more in terms of some bit of revival in terms of private investment and maybe flattish consumption, so that we see growth moderating from 7 to 6.4%.
I think Eco Survey gave a range of 6 to 6.8, and 6.4 is actually just in between that. Our own call is 6% because we do see global headwinds trimming our exports and also flowing to the sectors which service those exports. So I think overall the economy still seems resilient, but this resilience will be tested in when the global growth slows down.
The RBI MPC has given itself more room to tighten borrowing costs in the future to rein in core inflation. And amid the prevailing uncertainty, its decisions going forward will be largely data dependent.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.